I really didn't want to make another video about SCHD, given that I just covered this ETF a little over 2 weeks ago. But there was some pretty big news that came out about this fund that's got a lot of people talking, and some people are concerned about it. There was an article that appeared on ETF.com titled, SCHD Leads Dividend ETF Exodus with Big $7.1 Billion Outflow, which details that investors have been dumping this fund. In other words, more people have been dumping SCHD compared to any other dividend-paying ETF, including those offered by Vanguard and iShares, which is concerning. So let's take a look at this article to try to understand why this is happening and what we can expect going forward. According to the article, the Schwab US Dividend Equity ETF, SCHD, experienced $7.1 billion in outflows on Monday, with its total assets under management falling 10.2% to $69.9 billion, according to ETF.com daily fund flow data. So this fund losing $7 billion was a huge loss for this fund, which definitely raises a lot of eyebrows. What's more is that SCHD isn't even the largest dividend ETF out there. When looking at assets under management, the largest dividend ETF would be the Vanguard Dividend Appreciation ETF, ticker VIG. According to Vanguard, this fund currently has $90.1 billion worth of assets, so it's $20 billion bigger than SCHD. If we look at ETFDB.com, you can see this massive outflow showing on this bar chart, which looks pretty serious. So a lot of people have been talking about this, and they're wondering why this particular fund saw such a huge number of outflows. There's been a handful of theories as to what the reason for this was. I've seen some people suggest that investors are just pulling out of US companies in general, and they're instead focusing on more international opportunities, given how the markets have been performing this year and the cause of it. On the same day investors sold out of SCHD, the largest international equities fund, which is Vanguard's Developed Markets ETF, ticker VEA, saw a large inflow of investor money. But what's likely the best explanation would be its reconstitution. Every year this fund goes through the process of updating its holdings by selling some companies in it and replacing it with new ones. This took place after market close on March 21st, and it's possible that a large number of investors might not have liked how things turned out. So let's examine what changed and what we can expect from SCHD going forward this year. For starters, this ETF dumped 17 holdings from its portfolio, which includes the following. The biggest position that was sold was Pfizer, which made up 4.3% of this fund, followed by BlackRock at 3.83%, and then US Bancorp, which made up 2.55%. The reason these positions were dumped was because they were no longer the best picks when it came to SCHD's investment criteria. Schwab picks the highest yielding stocks out there as long as they have 10-year dividend track records, are large in market cap, have good liquidity, and some other features as outlined in their prospectus. In addition to removing 17 stocks, they also added 20 newcomers to the fund. The largest addition is ConocoPhillips, which is now 4.6% of SCHD. Second is Merck & Company at 4.01% and Schlumberger at 2.3%. So if we compare the additions and the subtractions from SCHD side by side, there's a couple things that we can notice. Almost all of the companies that were removed were either from the financial sector or the consumer discretionary sector. Pfizer is the only company that isn't a part of those two sectors that was removed. You can also see on the additions that energy was the most commonly added sector to this fund. They provided this breakdown of how much each sector now makes up of this ETF. Energy is now the largest sector in SCHD, representing 21% of all of its holdings. Consumer staples is now second, followed by healthcare at 16.1% and third. Healthcare was previously the largest sector before these changes took place. There's now also no exposure to utilities whatsoever in this fund. So what did these changes do for SCHD? According to the press release issued by this company, this ETF now offers a slightly smaller yield compared to before, but it's only 0.13% less. On the plus side, the average balance sheet of the companies inside this fund improved by a pretty good amount, which is great. Dividend growth also went up by a good amount, which is also good. As I've shown in previous videos, this dividend growth ETF already had the highest amount of distribution growth compared to the dividend growth ETFs offered by Vanguard and iShares, so now it's even better. The Sunday Investor, a Seeking Alpha contributor, put together this really nice chart that shows the changes before and after the reconstitution. The companies inside SCHD have a slightly longer track record of dividend payments, but slightly less in terms of consistent growth. Its dividend yield did go down slightly as previously mentioned, but its dividend compound annual growth rate went up by a pretty good amount. Also seeing an improvement is the average dividend payout ratio of the stocks inside of this fund. So overall, this year's reconstitution saw a lot of improvements in a lot of different areas, including diversification in terms of the number of companies it holds, dividend growth, and slightly better financials of the companies inside of this ETF. But now let's focus on what's not to like about the changes made. The Sunday Investor pointed out something really important, which is that SCHD's payout ratio is extremely high when compared to other dividend growth ETFs. You can see with VYM, for example, it has an average payout ratio of just 48.02%. This means that for the average company inside of SCHD, they're paying substantially more of their earnings to shareholders, and a higher payout ratio means higher risk. Some people have also pointed out that they have an issue with energy making up so much of this fund now. At 21%, this is more than the largest sector before the reconstitution, which was healthcare at 18.2%. It's also been pointed out that SCHD hasn't been that great of a grower from a share price perspective, and with the changes that were recently made, growth could be slightly slower than before. So these appear to be the biggest concerns investors have with this fund going forward, and this may have helped cause the sell-off last week. There's a few things that people need to keep in mind though. SCHD did not change its strategy. They still pick stocks in the exact same way that they've been picking them, and it just so happens that this time around, more energy companies fit into their criteria. Plus, despite being a slower grower in terms of share price, its dividends have helped it outperform nearly all of its peers. Using our DRIP calculator, which calculates the total return of a dividend-paying investment and it assumes that you're reinvesting your dividends back into buying more shares, we can see that SCHD has outperformed both VIG and VYM. The Sunday Investor recommends people take a look at FDVV, which is Fidelity's high dividend ETF. When we compare this fund to SCHD, both have almost identical total returns. However, FDVV, according to Seeking Alpha, has a 5-year dividend growth rate of 4.44%, while SCHD's is 11.44%, more than double the dividend growth. Now, there's nothing wrong with FDVV if that's what you prefer. It's been a great performer. If, however, you want to someday switch from reinvesting your dividends to having them automatically be deposited into your bank account, SCHD looks like the superior choice to me, considering that it does pay higher dividends and it grows them much faster. So I see no reason to be concerned about this large outflow from this ETF. Nothing changed in terms of their strategy, and many of their metrics improved with this reconstitution. Other dividend funds, according to this article, also saw outflows, although not as severe as SCHD. If it is true that this ETF isn't going to grow much in share price, its improved dividend growth is still going to result in excellent gains. People who invest for dividends should be most concerned about dividends and not whether or not the share price isn't growing as much, and SCHD still looks solid. Let me know your thoughts in the comments, but with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.